We all know the names: Apple, Microsoft, Amazon. When you're building a portfolio, it feels safe to park your money in the everyday megabrands that dominate our lives. These tech giants have unstoppable momentum. They reshape consumer habits and generate billions in free cash flow, appearing as the only reliable engines for growth. Look at the actual math of a standard index fund. Just 10 megacap companies account for over 40% of the S&P 500's value. You pay a premium for that dominance. Their price-to-earnings ratios are historically stretched, often exceeding 30 times their trailing earnings. Relying exclusively on a top-heavy index means your financial future is tied to the performance of a few massive tech firms. You concentrate your risk, and because these companies are already so large, their ability to double or triple in size is mathematically constrained. True portfolio resilience requires balancing the predictable stability of the giants with the raw compounding growth potential found further down the market ladder. To find that balance, we first have to measure a company's actual size. Market capitalization is a strict mathematical calculation. Take the current share price and multiply it by the total number of outstanding shares. This gives 3 distinct categories. At the top, large cap stocks are mature entities exceeding $10 billion. One step down, mid-caps are expanding companies between $2 and $10 billion. Finally, small-cap stocks are younger, emerging companies, valued from $300 million to $2 billion. These brackets reflect a company's internal capital structure, its access to credit, and its specific phase in the corporate life cycle. Treating all equities as identical pieces of paper ignores the reality of how these businesses actually operate. A local manufacturer survives under economic pressure very differently than a global software monopoly. Large cap corporations utilize their massive scale to construct highly diversified operations. They operate across multiple geographic regions and business units. If a recession hits one country or a supply chain breaks down in one sector, these companies can lean on their other divisions. That global footprint insulates their revenue streams from localized domestic economic shocks. But that size comes with a cost for investors looking to beat the market. U.S. large caps represent one of the most efficient asset classes in the world. This matrix tracks the trade-offs across the market cap spectrum. Because large caps are heavily researched by dozens of Wall Street analysts, their pricing is highly efficient. Every piece of public information is already baked into the stock price, leaving almost zero mispriced hidden gems for an active investor to exploit. You gain high liquidity and consistent dividend payouts, but your future growth rates are mathematically constrained by their massive starting size. A $2 trillion company simply cannot double its revenue as fast as a $2 billion company. Therefore, large caps should serve as the defensive, stabilizing foundation of your portfolio. They preserve your wealth, rather than acting as the primary engine for aggressive wealth creation. Mid-cap companies occupy a unique transitional space. They have survived the perilous, high-risk startup phase, but they are still small enough to experience periods of rapid, compounding expansion. These businesses have proven commercial models and are actively capturing market share. That proven success makes them highly attractive targets for corporate acquisitions. Instead of spending years developing new technology or entering a new market from scratch, large conglomerates will simply absorb their smaller, high-velocity rivals. When these buyout transactions occur, the acquiring company typically pays a significant premium over the current market price. Existing mid-cap shareholders capture that immediate, lucrative payout. As we update the matrix, you can see the trade-off. To capture this aggressive expansion and acquisition upside, you must endure higher medium-term volatility and a greater sensitivity to economic downturns than you would with a large cap. Mid-caps offer a highly effective compromise. They capture the aggressive growth phases of a young business without exposing you to the extreme mortality rates of micro-startups. At the base of the market, we find small-cap stocks. Historically, these companies are the drivers of the size premium, the academic observation that smaller companies have significantly higher long-term growth ceilings. Small-cap enterprises typically derive 70 to 80% of their revenue domestically. They don't have global buffers. Their survival depends entirely on the health of the local consumer economy. They also lack the deep cash reserves of their larger peers. To fund their daily operations and expansion, they rely heavily on external debt financing and banking credit lines. This structural reliance on debt makes them extremely sensitive to monetary policy. When the Federal Reserve hikes interest rates, borrowing costs spike, and small-cap profit margins are immediately squeezed. When we look at the final column on our matrix, we see high volatility and high debt sensitivity, and this creates a trap. Buying a broad, unfiltered small-cap index, like the Russell 2000, exposes you to hundreds of unprofitable companies and highly leveraged biotech firms that are burning through cash. To solve this, you have to apply a strict positive earnings filter. Indices like the S&P 600 require a company to be profitable before it can be included. This simple quality screen drastically improves risk-adjusted returns by eliminating the junk. Small-cap investing can deliver the highest rewards in the market, but you must accept severe price swings and mandate strict active quality filters to ensure that reward is worth the risk. So how do you map these market caps to your money? This flowchart breaks down 3 profiles based on timeline and risk tolerance. First, the baseline accumulator. Shorter timeline, lower tolerance for drops, and limited research time. For this profile, a passive large-cap strategy makes sense, prioritizing stability and minimal fees. Next is the horizon builder. These investors have 10-year timelines, enduring market drawdowns without panicking and selling at the bottom. Horizon builders benefit from a blend strategy, anchoring with large caps but allocating 10 to 20% to mid and small caps to capture the size premium. Finally, the tactical optimizer. Experienced investors actively managing risk to bypass mega-cap overvaluation. Tactical optimizers use active managers or profitability-filtered indices. This targets specific market inefficiencies, exploiting the valuation gaps left behind by passive index funds. There is no singular, universally perfect portfolio. There is only the specific ratio of market caps that matches your distinct financial life cycle. Ultimately, mastering asset allocation means mastering the trade-off between predictability and potential. Think of your portfolio as a cohesive mechanical unit. It requires both heavy, immovable defensive strength and rapid, agile offensive capability. The large caps act as the veterans, defending the wealth you've already established. The small and mid caps serve as the rookies, aggressively driving your future growth. Long-term financial success comes from intentionally engineering a portfolio where companies of all sizes work together.